Hello, I'm Tom Selby, AJ Bell's Senior Analyst, and welcome to Fundamentals, where I'm going to look at one of the most popular exchange-traded funds on the AJ Bell Invest Centre platform right now, namely the iShares MSCI Latin America ETF. This tracker product is an exchange-traded fund. That means it's designed to track or mirror the performance of the underlying assets and deliver that performance minus any running costs. This means the tracker is following the day-to-day price movements of the MSCI Emerging Markets Latin America Index as closely as it possibly can. The ETF seeks to do this by physically holding securities that appear in the index, and the product comes with a charge of 0.74%. The tracker was first launched in 2007 and has assets of just over £1.2 billion. It sits at 6 out of 7 on the Morningstar risk ratings, meaning it is a potentially high-risk investment where returns could be very high or very low. If you're interested in analyst opinions, Morningstar has given the ETF a 3-star rating. The 5 biggest stock weightings include 3 Brazilian firms, Itaú Unibanco, Ambev and Banco Bradesco, and 2 from Mexico, América Móvil and Fomento Económico Mexicano. The chart to my left shows the tracker's weightings by sector. The biggest exposures are financial services, basic materials, and consumer defensive stocks. So those are the basics, but why exactly are advisors and clients purchasing this product right now? Emerging markets have been a dog of an investment in recent years. As developed countries flooded the economy with cheap money through vast quantitative easing programs, a huge portfolio shift took place that saw assets shift towards developed regions at the expense of emerging market asset prices and currencies. The rising dollar and falling commodity prices have also hurt emerging markets. And if emerging markets as a whole have been a dog for investors, then the biggest canine in the pound was Latin America. According to Ashmore's Jan Dean, Latin America's particular vulnerability to the global economic shifts stems from its greater dependence on commodities, where prices have plummeted, and heavy reliance on foreign savings and portfolio flows. With political uncertainty in the region still rife, and the Mexican president's ambitious reform program seemingly running into the sand, Latin America's poor recent performance is hardly surprising. However, in 2016 things have turned around, and dramatically so. The chart on my left shows how the iShares MSCI Latin America ETF we're focusing on today has fared in the past 5 years. In 2013, the fund dropped in value by over 17%, then by almost 11% in 2014 and nearly 30% in 2015. This year so far, however, the ETF has delivered whacking returns of 45%, albeit after 3 pretty awful years of performance. So what exactly is going on? Well, this year has seen the price of oil, gold, wheat and sugar rise, providing a welcome boost to the commodity-reliant region. Looking at specific countries, Brazil's interim president, Michel Temer, has embarked on a huge structural reform programme designed to cut spending and balance the budget. Inflation has already dropped back from over 10% to below 9%, with experts expecting the figure to reach 6.5% to 7% by the end of the year. If that happens, the central bank may feel it has enough wiggle room to cut interest rates, lowering borrowing costs and potentially providing another fillip to the economy. Argentina's leadership has also changed in the past year or so, and President Mauricio Macri opening up the country to foreign capital and allowing the currency to float freely. However, interest rates still stand at over 35% amid soaring inflation. It's also worth noting that, historically at least, emerging markets tend to move inversely against the dollar, which is currently weak on the US Federal Bank's decision to delay raising its target interest rate. That's all from me this week. Thank you very much for watching, and I look forward to seeing you again next time.